There's an interesting saying, right? What gets you from A to B does not necessarily get you from B to C. And I think this can't be more true in the investment world and in the personal finance world. Because at the very beginning, everything that counts is income and is savings rate. Now, if you don't have a high income, then having a high savings rate is pretty much impossible, right? And of course, if you've got a ton of lifestyle inflation, then saving a lot is also a problem. So at the beginning, it's all about not inflating your lifestyle too quickly and to be able to increase your income faster than your spending expectations. So this is what it's all about at the beginning. But then over time comes a flip. Over time, investing becomes more important. It becomes so important that saving in the end barely matters and that it's all just about investing. So the focus moves more and more from saving to investing. And that has basically two reasons. So what I like to look at is I like to look at the relationship of your income relative to your wealth. So it's not necessarily important if you've got $100,000 or 1 million or 10 million. What matters is how much income do you have or how much expenses do you have relative to your wealth. So the relationship between the two matters. Let's say you've only got, say, 3 months of your income saved up, right? Your net worth is 3 monthly income. Then how much does saving have an impact for you? How much does investing have an impact for you? If you save a lot, right? Let's say you save 30% of your income over the course of 1 year, then you've got 4 additional incomes and you've basically doubled your net worth. So in 1 year, you can double your net worth simply just by continuing to save. If you now even increase your income further and you can have a savings rate of 50%, now you potentially triple your net worth in a year. Right? So those kinds of relative gains are very hard to attain when you invest. So at the beginning, when you don't have much, everything is about saving. Everything is about generating high income and stashing away as much as possible. But now let's say you go on for a while like this. And let's say after a few years, you've got, say, 5 annual incomes saved up. Okay, so it's not just a few months anymore. You've got 5 years of your income saved in net worth. Now investing becomes way more important. Now saving becomes way less important, right? Let's say you were still to save half of your income for an entire year. You would increase your net worth from 5 years to 5.5 years. So only an increase of 10%, even though you're saving that much. So saving doesn't really matter that much anymore. But investing does. Because let's say those 5 years are not invested at all and you just put them away in cash. Then you lose a lot towards inflation, right? You lose a lot towards monetary expansion. The monetary base in the US expands by roughly 6.8% per annum. And so when you've got 5 years stashed away and you lose 6.8% of those 5 years, then that's roughly 3 to 4 months of salary that you're giving up to inflation. It's basically almost all of your savings. So you're saving half of your income, you have all of your money just in cash. All of those savings don't help you at all in terms of purchasing power because you're losing that much purchasing power with the money that you've stashed away. So the importance of saving decreases over time. The importance of properly investing increases over time. And this is exactly what I mean with what gets you from A to B does not get you from B to C. It's super important to focus on income and on saving at the beginning, and you should not necessarily put that much brain power into growing your net worth of 2 or 3 months. Because even if you were to double your 2 months in a year, it's way less than what you could achieve simply by working more and by saving more. But then if you get used to this over the years, right, and after 10 years you simply still follow that principle, you're not going to get ahead, right? You will hit a plateau because the devaluation of your wealth will take over.
This needs to go to 1 million or March buyers now will make millions. This is how you get the clicks on YouTube, but this is not how you beat the market. To beat the market in crypto, you need to be better informed than the rest. You need to be better skilled than the rest. You need to do better blockchain analytics. You need to track other people's wallets and know what is the smart money doing. It's the boring educational content that forms skill that doesn't perform so well on YouTube though. That's why I created the premium membership. Feel free to check it out. We are tracking influencer wallets to find out what they are buying before promoting this on YouTube. We've got a lot of tutorials to help with on-chain analytics, to help with wallet discovery. And of course, there are also plenty of chats where we help each other and also one-on-one conversations with me. So I'm messaging every premium member one-on-one directly. Once you're joining, you will get a message from me and you have the opportunity to directly pick my brain. Feel free to check it out, thebitcointrader.com. Link is down below.
Saving won't make a big difference anymore to your purchasing power. You will not grow anymore. And that's why investing then becomes important. And so the way to invest is also, I believe, very, very different to when you're just at a few months or maybe at 1 or 2 years relative to, say, when you're at 5 years. Because when you, say, have just 2 or 3 months of net worth, then you can pretty much all put this in one single asset class. You could put it into something very, very risky. You could put all of your money into, say, Bitcoin. Right? And even if Bitcoin was to go down by 50% and your net worth goes from 3 months to 1.5 months, that's not necessarily a big problem for you because you can buy the dip very, very aggressively because you save, say, half of your income. After 3 months, you've already completely made up of that loss, right? You're back to square one after saving just for 3 months. Now, this does not necessarily work when you're at 5 years of net worth, right? When you crash by 50%, when you had 5 years of net worth, now you need to save 2.5 years. And if you save half of your income, that takes you 5 years. So saving 2.5 years of income with half of your income takes another 5 years and not just a few months. That's why reducing volatility as much as possible while maintaining expected returns is so important once you are a bit more wealthy. At the beginning, you can all put it in the one thing that you believe in most, and you can simply just buy the dips and you can ride out those waves. Once you are a bit ahead in the game, and once it's actually important that you master this investment game to a degree, because saving is way less important than actually investing. Once you are at that stage, it's important to be somewhat diversified with assets that have long, high expected returns. So you don't want to be diversified with gold and government bonds and a fully paid off house. You want to be diversified with tech stocks, with maybe silver, with maybe Bitcoin, and with maybe a levered house. So with a lot of debt relative to equity in the house. So that in the end, the equity that you have in the house still appreciate enough. Right? The reason why people get money with property investment is because they've got a lot of cheap leverage on this. The reason why the return on investment is so high is because the debt devalues faster than what you potentially pay for the debt. So whenever you buy a house, make sure that you lock in an interest rate that's less than 6.8%. Right? 6.8% is the monetary debasement over time. If you can finance your debt for less than that, then you will make money over time with a highly levered property. And so it's all about beating monetary debasement. It's all about doing this without crashing by 50% in your network. And actually the crashes that we sometimes see in different markets can then be used as an advantage, right? When you have very little net worth, you can obviously take advantage of those crashes because you buy in with your regular cash flows. If you've got a lot of net worth, right? Let's say the 5 years, then crashes in individual asset classes still help. Because let's say Bitcoin crashes to say 30K and your silver does not crash, you can sell some of the silver and buy the Bitcoin crash with it. So instead of buying the crash with your regular income, you now buy the crash with those other asset classes. Because with your regular income, you're not buying enough because your regular savings rate isn't high enough relative to your wealth. So you have to buy the crash with other things that you own. That's why you have to own different asset classes at some point. And so there are different levels to the game, right? There is the few months mark, there is the few years mark, but there's also one important cutoff that happens later on, that happens at roughly 20 years. So once you're able, through investments, to grow your 5 years of expenses, say, or 5 years of income, to 20 years of expenses. So not 20 years of income, but 20 years of expenses. Once you can grow your wealth to 20 years of expenses, at that point in time, you can consider yourself financially free. You can consider yourself retired, because you only need 5% real return on that money, and that will cover your expenses fully. And the 5% return, again, are easily achievable simply by owning the different asset classes. You don't even have to shift across the different asset classes anymore. You can simply just have a diversified portfolio and let that run. You will get your 5% real return very easily. And you might not necessarily outperform monetary debasement by 5%, but you're very likely going to outperform at least consumer good price increases by those 5%. So you should be okay, you should be fine, simply just owning a broadly diversified basket of stuff without reshuffling the weightings too much. Once you're at the 20-year expense mark, then the game is pretty much solved. So to get from A to B, you increase your income a lot, you learn a skill that's highly paid, you save a ton of money. From B to C until retirement, you have to invest very nicely, you have to shuffle your weightings for different portfolio allocations of different asset classes that aren't too much correlated to one another. And once you are at C and you go to D and you are at the 20-year mark, then it's simply about staying at that level. It's not necessarily, monetarily at least, needed to grow much further than that, right? If you feel comfortable with those expenses and you don't want to inflate your lifestyle way beyond that, then simply just stay at that level and don't take on too much risk, right? You don't want to move from 20 years of expenses down to 10 years of expenses simply because you took on too much risk. And so what do we learn from all of this? I think it's important to not focus too much on catching the next meme coin when your net worth is just 2 or 3 months of your income. Playing with the meme coins is something that you can sprinkle into a portfolio once you've already got a few years of income. What's way more important than leveraging the capital when you don't have much capital, what's way more important at that point is to really increase income, is to really increase the savings rate. It has way more impact. You can easily double and triple your net worth if you simply just put your mind towards income generation. Doubling and tripling your net worth with crypto speculation is way more risky, is way less likely to happen. And all of those hyper risk on assets are really just for people that have some play money on the side and that have actually already a pretty solid base in other assets. If you found this useful, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. Last but not least, feel free to also join our Telegram. There's a link to our Telegram directly below this video. Looking forward to chatting with you. Cheers.